How's it going, everyone? I am Dan Lomar, CFP professional with United Wealth Management, where we specialize in PR management and financial planning for pilots at United Airlines. And like many of you, my business partner, Alan Bewley, and I are both pilots for United. Thanks for tuning in. Welcome to another video. Hey, before we get going, if you haven't done it yet, remember to subscribe and hit the bell icon so that you get notified when new videos come out. So the question of the month is, what should we do with the darling stocks of 2020? Facebook, Amazon, Apple, Microsoft, and Google. Buy, hold, or sell? Well, you know what? It really depends on your financial situation. I don't know what's going to happen with these stocks, but we're going to take a look at things from both a historical point of view and also from a financial planning point of view to help you make up your mind whether they belong in your portfolio or not. So let's jump right into it. Right now, we're looking at these darling stocks of 2020. Facebook, Amazon, Apple, Microsoft, and Google. Some people would throw Netflix in there, and they call them the FAAGM stocks, but Netflix is not actually one of the 10 largest companies, so that's why I didn't include it in the analysis. But if you took an equally weighted portfolio in 2020 and invested 20% of your money in each one of these, then the average return up through the end of October is 37.5%. So they have just been killing it. Meanwhile, the S&P 500 over the same period is up 1.2%. Now, I'm recording this in the middle of November, so the return's a little bit different as it is right now. But either way, what we're showing here is these things have been leading the way, doing the heavy lifting in the S&P 500. So let's take a look at things historically. These have become 5 of the largest names in the S&P 500. So let's take a look at things historically and how have large cap names done once they got into the once they became the 10 largest names in the S&P 500. So let's draw some parallels between what we're seeing today and what we've seen throughout history. So you'll recognize some of these big names: AT&T, General Motors, General Electric. What we see, first of all, is that a lot of these big names, once they become in the top 10, they tend to stay there for a very long time. Some of them are longer than others, but for the most part, once they're there, they tend not to go anywhere. So that's one thing we could say is we wouldn't expect the large names, the big cap names of today, to go anywhere anytime soon. Secondly, concentration of the stock market in a few large names is not unprecedented. As it stands right now, these 5 stocks make up about 20% of the S&P 500 market cap. And then also to have high-tech innovators in the top of the S&P 500 as far as market cap goes, that's not anything new either. So we can draw some parallels between what we're seeing today and what we have seen throughout history. So we'll use that when we look at some performance comparisons, so that we have that parallel drawn out there. Now, one other thing I would like to say too is myself and my clients is we tilt our portfolios towards small cap value. So that's the opposite asset class than large cap growth, which is what these names are. So one of the questions that has come up lately is the dominance of large cap growth, has it been a hindrance or is it an issue for small cap value investors? And this is a fairly common question here lately because over the last 10 years, stock market returns have been dominated by large cap growth. Is that an issue for small cap value? Not necessarily, and we look at this as within the range of normal possibilities. If we look throughout history, even in the face of large cap domination, this value premium has showed up 6 of the 9 decades, and over the course of the entire period, according to research by Dimensional, the value premium has shown a 3.2% premium on average over that entire period. So we're not really seeing anything new as far as large cap growth interfering with small cap premium. Yes, we're coming out of a 10-year period where large cap growth is dominated, but we don't see that outside of the normal range of possibilities. And here's a little bit of evidence of that. If we just look back at the past 2 months at the stock market, even though this is just a drop in the bucket, it is just a small slice of the very, very, very thin, small slice of evidence here. But we had a small pullback in September. And since that time period, these large cap names have actually lagged the S&P somewhat. Here's the S&P, here's 4 of the big names right here. And what we've seen here is actually the iShares Russell 2000, that's the Russell Small Cap Value ETF, is actually one of the leaders out there. Is this going to be a permanent shift? Does this mean there's a new trend coming? We really don't know, but I think the point of it is, in the face of large cap growth dominance as far as an asset class, that small cap value is still well and alive. So let's look at history. How did these stocks perform once they became the top, the 10 largest companies in the S&P 500? So as they grew up and as they grew into being the top 10 companies, we saw some excellent performance. These are premiums relative to the market, so it's not absolute growth, but on average, they showed a premium as they grew 10% annually on average for the 10 years prior, 5 years prior, 3 years prior. We see these premiums relative to the market. So they had awesome growth as they grew into becoming these large cap behemoths that they have been throughout history. And we're seeing something similar with that right now with the 5 stocks we're looking at today. 15, 17.7, 19.9. So not exactly what we've seen throughout history, but not out of the range of expected outcomes either. So once they became the top 10, how do they perform after that? Well, there's a little bit of shift in the performance premium here. And that is then 3 years after becoming the top 10, on average, these stocks outperformed by 0.7%. And then the 5 and 10 years after, they actually underperformed the broad market by -1 and -1.5% accordingly. That doesn't mean that they were bad companies. It doesn't mean they went anywhere. It doesn't mean that's going to happen with these 5 companies. All we're showing here is that historically, the growth that took them into being the top 10 companies historically didn't persist once they were there. Is that what's going to happen with the 5 companies we're talking about right now? I have no idea. We're just making a simple historical comparison here. So one of the questions that comes up, if you've been holding these or even observing these, is the tendency is to fall in love with these types of things. And when we fall in love with stocks, it tends to cloud our judgment, and we might ask the question, what could possibly go wrong? And we don't want to get so caught up in that we're not looking at the evidence, making rational decisions. So let's just look at a case in history and some anecdotal evidence of when this happened in the past. And back in the 60s and 70s, there's a group of stocks called the Nifty 50. And the sentiment at that time was there's a quote from Forbes magazine, the delusion was that these companies were so good, it didn't matter what you paid for them, their inexorable growth would bail you out. And so that was the sentiment at the time, is that no matter what you paid for them, it didn't matter. They were going to grow into the price to earnings ratio in which you paid for them. Well, the problem is by the late 1960s, their PE ratios got super high. People were still buying them. Then we had a bear market in the 1970s. And for some of these stocks, it took until 1982 until you saw positive returns on those things. So during that bear market, these particular stocks got hit especially hard. So all I'm saying here is I don't know if that's what's going to happen. Not suggesting that's going to happen with the big names today. All I'm saying is we want to be open to the possibilities where it can happen. We don't want to fall so in love with a group of stocks that we are blind to the possibilities of what could happen on the downside. The other thing I like to take a look at are range of returns, range of outcome possibilities. When I'm looking at a portfolio, and this is using some of the software we use for portfolio management, and that is, if you look at the big names right now, obviously they've got a higher potential return on the upside, but they've also got a lower potential return on the downside. And so these are just some comparisons I like to make when I'm looking at portfolios as to what their risk is and what their potential range of returns is compared to the broad market. And then one of the reasons that's good to know is because what if your personal risk tolerance was a lot lower than the portfolio itself? That's something that you would want to be aware of. And that's one of the things that we do for our clients when it comes to selecting portfolios for them. So there's a couple things to consider when it comes to you making your decision where they belong in your portfolio. So what do we do? Buy, sell, or hold? Honestly, it truly depends. Nobody knows what the answer is. As far as what the stock price is going to be, if you're a speculator, I can't help you there. I have no idea specifically, if there's a price target on these or what the chances are of them reaching them, whatever the case may be. But I'm not a speculator, and if that's the way you're going to be investing, then I think over time you might end up driving yourself crazy, because it's not to be a good investor, you don't have to know what stocks are going to do over the next 6 to 12 months. The way I look at those, I look at it from a life and a financial situation. Again, we have two different situations here. If a person is holding these stocks in a portfolio and they're 25 years old and they got 40 or 45 years before they retire, that's an entirely different situation than a person who is 65 or 64 coming up in retirement and they have to start generating retirement income. So the question of buy, hold, or sell these stocks in a retirement portfolio, look, if it's a small, acceptable position in a diversified portfolio, hey, great. But if you have to start generating retirement income on a repeatable, consistent manner from a portfolio, you got to look at all your assets, and the buy, hold, or sell question would not be the first I would start. I would start with a much broader picture. As far as holding them in a diversified portfolio, that's the way we do things. We've held these stocks since they were so small we didn't even know what they were, and we don't see changing anything. But the biggest difference is that we're holding them in not a concentrated position. They're at very acceptable levels for the risk of the portfolio itself. So we don't really see changing anything in a broadly diversified portfolio. And just one last thing to keep in mind as you're considering your stock picking or however you choose to invest, and that is, can you distinguish luck from scale? And so I like to point that out because a lot of people pat themselves on the back based on the research that they did, but the fact of the matter is that the best stock pickers on Wall Street, and I use best in air quotes because it's a pretty loose term, is you can't distinguish luck from skill. So what that comes down to is the way you're doing things, the way you're investing, is it repeatable? Can you repeat the results you've had? And so that's just something to keep in mind as you make up your mind where these stocks belong in your portfolio. Anyway, I hope that all makes sense. I appreciate you tuning in. If you got any questions for me, shoot me an email, dan@unitedwealthmanagement.com. And if you would like a portfolio analysis for yourself to see where your risk tolerance is for your portfolio, I'd be glad to do it as a paid project. Again, reach out to me, dan@unitedwealthmanagement.com. If I don't hear from you, thanks for tuning in. Once again, remember to subscribe and hit the bell icon if you haven't done that yet. Until next time, fly safe.